So when the market's going up, I often get questions about why I sound so bearish. Why am I posting videos about the Hindenburg omen and other signs that the market's potentially rolling over? So let me clarify. I know the trends are going positive. As a matter of fact, if you watch my content on this channel and on StockCharts TV, I talk often about the clear uptrend in the markets, the leadership names that are working. I think your goal as an investor should be threefold. Number one, identify the trends. The trend overall for the market is going up. Number two, follow those trends, which hopefully you've been doing. I own plenty of stocks, mostly through ETFs in my own accounts. But the third step, the third and arguably most important one, is to look for signs of trend exhaustion, anticipate potential turns. And that's why looking for the Hindenburg omen or three signs of a market top, three signs of the bear, as we'll talk about in today's video, why I think that's so important. Now, I'm not talking about signs of an actual bear. This is what that looks like. This is what happened when a 200-pound black bear tried to get into our backyard, which it did a number of times, ravaging our trash and compost cans, which I now have behind a lock and key in that shed behind me. We're not talking about signs of an actual bear. We're talking about signs of bearish activity in the market. So before we get to the three signs of the bear, here's one more thing I wanted to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So first, let's set the stage and clarify the fact that the trend overall is still quite positive. 100%, no disagreement here. And what I would tell you is there's a big difference between the trend we've observed to date and the conditions we're observing that tell us about the likelihood of the trend going forward. And that's where I think things may be a little bit different. But in terms of the trend overall being positive, this is a market trend model that I started using years ago, and I've tweaked it over time, but really helps me capture the overall trend on three time frames: long-term, medium-term, and short-term. We don't have time to go through all the details of this model in this short video, but there's a link in the description to another video that describes this in a little more detail. But overall, the long-term model for me has been positive since the end of March of 2023. The medium-term model, which I think of as my main risk-on, risk-off model, has been bullish since early November of 2023, coming off of the October low. And my short-term model has been bullish consistently since mid-April, coming off of that brief pullback. So I am not in disagreement. Overall, the trend has been positive. But as I mentioned in the introduction, there are three parts to this game that I think we play as trend followers. Number one, identify the trend. It's up. Number two, follow the trend. It's still going up, and ride that as long as humanly possible. But step three, always be looking for signs of a downtrend reversal. And that's where things like the Hindenburg omen, which I'll link to in the description below, like other indications like the three signs of a bear, which we're going to talk about today, are so vital because they help you anticipate a top instead of just being surprised and confused by a market top. So what are the three signs of the bear, an actual market bear? Well, step one is a bearish momentum divergence, and not just one, but a group of them, a proliferation of bearish momentum divergences. What happens as the market goes higher is you tend to have stronger momentum because buyers are outnumbering sellers, buying power is overwhelming selling pressure, and as a result, the market continues to go higher until something changes. And we've certainly seen that, besides a brief pullback first 2 weeks in April. Overall, the market has been remarkably strong off of the October 23 low. Something interesting is happening, though, in the last 4 weeks, from about mid-May to mid-June. Look what happened from mid-May, where the RSI, and this is a measure of momentum for the S&P 500, just touching that overbought level here in sort of the second and third weeks in May as we broke above 5,300 for the first time. Now we're closing above 5,350 for the first time in the last week, and look how the RSI is lower. So we had the S&P 500 making higher closes, but the momentum actually trending downwards. Now, it's still a little too early to declare this a clear bearish momentum divergence. I think you'd have to have more of a pullback here to confirm that what we observed this week is a high, and that we're not just in the midst of an upswing that continues next week. But for now, if we would rotate lower, I think this would be a very valid bearish divergence of higher highs in price, weaker peaks in momentum. Now, one of the reasons why I think that's maybe a likely scenario is because we're already seeing those bearish momentum divergences in other places. Remember what I mentioned, it's not just one that you're looking for, it's a series of them. Amazon at the beginning of May actually had a bearish momentum divergence, higher highs in price, lower peaks in momentum, overbought in early April, not overbought with an RSI around 60 in early May as we made a new all-time high. Eaton Corp, which is a industrial company based in Northeast Ohio and the Cleveland area, made higher highs April into May. Look at the lower peaks in momentum, overbought here in April, not overbought in May. Starting to see more and more of these. You can see Amazon and Eaton actually have already sold off after that bearish momentum divergence. The S&P maybe is going to do a similar sort of pattern. My point here is that the more of these bearish momentum divergences that you observe, what that should indicate to you is that even though price is still going up, there's less upside momentum. There's less fuel behind that rush to make new all-time highs. The second thing I'd be looking for is breadth failing to confirm a new market high, and I think we're starting to see that here in early June. Here's the S&P 500 just on a closing basis. You can see it coming off of the October low, moving higher obviously in the rest of the fourth quarter. And again, besides this pullback 2 weeks in April, overall the general trend has been higher. And every month, besides April, we've made a new swing high. Now we're right around 5,350, and if you look, as the S&P went higher here the first week in June, the advanced decline line for the New York Stock Exchange actually has been trending lower. And actually just barely, it might be a rounding error, closing below the 50-day moving average for the first time since the end of April. So you have the S&P making new all-time highs, closing above 5,350 for the first time, but the breadth data is not confirming that new high. You actually have the 80 line for the New York Stock Exchange sloping downwards. And that's not it. Here's the advanced decline line for the S&P 500 large cap index, for the S&P 400 mid cap index, and for the S&P 600 small cap index. All four of these advanced decline lines are trending lower while the S&P is trending higher. Now, you may point out, which you would be absolutely right, doesn't that just mean the mega cap names, the magnificent 6 or 7 or whatever we're calling them, are doing the lion's share of the gains, and that's what's driving breadth data lower as the market's going higher? You're absolutely right. And the reality is, even though we've had periods of narrow leadership, even in recent market history, if you go back through multiple cycles, through multiple decades, it usually is not the sign of a healthy bull market environment when you have the market going higher and the breadth conditions are weakening, because that means the average stock is just not participating. That usually means that whatever gains you're seeing are more temporary and most likely unsustainable. Finally, we get to the third item. And again, these are 3 items that I'm picking out, by the way, 3 signs of the bear among a full bull market top checklist that I designed years ago. Actually, if you're interested in that full checklist, you may want to consider being a Market Misbehavior premium member, because they have access to the full checklist. We do a lot of discussions about comparing that checklist to the current market environment. So if you really want to track these conditions as they potentially deteriorate, and if you want to navigate this summer market top, which may be happening, well, click on the link below or go to marketmisbehavior.com/premium. Use the code YouTube, by the way. You'll get 20% off your first 12 months. I hope to see some of you join as a premium member so we can continue this discussion in a little more detail. But that third sign of a bear, by the way, is a breakdown and a breakdown of a line in the sand. For me, I love to think of things simply as much as possible, right? I think we in the financial industry, and having spent my career in the financial industry, we love to overcomplicate things as an industry. Personally, I love to simplify things. I love to take the complex and make it more manageable and accessible and simplified. And so I think of a line in the sand. While we can do all sorts of analysis of price and trend and momentum and breadth and sentiment, I think the very simple exercise of defining a level of risk, and if we break down through that level of risk, what I call a line in the sand, that indicates that there is a change of character. That means that something's changing. And right now, I would say a simple way of tracking that level of risk would be to draw a trend line. I'm starting at the October 23 low. That connects to the mid-April low, the late April low, the early May lows. Actually lines up almost perfectly with the low just over a week ago at the end of May. That trend line, that pink trend line, really defines the pace of this trend over the last 7 or 8 months coming off of that October 23 low. And I would say as long as the price remains above that pink trend line, we're obviously still making higher highs and higher lows. We're obviously in good shape. We break down through that pink trend line, that would tell me that something's changing. And when I say a breakdown of a line in the sand, for me, breakdown through that trend line support may be just enough to confirm that this uptrend with a certain pace and a certain look and feel is now starting to change. So those are the 3 signs of the bear that I'm looking for. Number 1, bearish momentum divergences. Prices moving higher on weaker momentum. Number 2, breadth not confirming new highs. And I think we've seen that with the advanced decline data starting to look weaker than you probably would want. Step 3 would be breakdowns of line in the sand. I think the S&P 500 provides some clear lines in the sand to work with. And whether you use the trend line support, whether you use the 50-day moving average, or maybe just a more recent swing low, S&P gets below 5,200. It's cleared all 3 of those items, those line in the sands that I just mentioned. So keep your alerts updated. I would encourage you to remain vigilant as we observe the market going higher, but as we observe conditions underneath the hood starting to deteriorate. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.